Hello, Randolph, can you hear us? What's your question?
It's Randolph.
Randolph, sorry, mate.
How are you doing? We're in the process of putting a will together, and in the case something does happen to us, it'll go to our children. Now, at the same time, they are both married, but we want it to go to their children. Is that possible, rather than the partners?
Well, yeah, it definitely is possible. And again, it's through the use of testamentary trusts. So essentially the beneficiaries within those trusts are the ones that you're nominating. So it's your children, and then their children. Mm-hmm. So there's a direction in terms of where it's going, and they get the benefit of the income and the use of the capital of the trust whilst the children are alive, and then when they pass, then the trust will be there for the grandchildren as well. So that's the best way to segregate them. And you may want to have two trusts for the two separate families if that's the case as well.
Okay. Our next caller is Harvey. Harvey, what's your question for the panel?
Oh, hi, how are you going? The question I have a family trust. A few years ago, we have two companies, and we sold the companies to the family trust. Now, the family trust is my sons and myself and my wife, and the sons are also directors and operators of the companies. Now, I just wonder how safe the family trust is against litigation if something happens in those companies and someone wants to sue the companies, being tax department or be a divorce settlement, whatever it might be, anybody. How safe is that trust now?
Well, in the first instance, the family trust, in my understanding in this situation, is just the shareholder of those companies. So your first instance where you may have someone taking action against the company would be someone suing the company for, a contract dispute or something like that. In those situations, it's normally just the company assets that are up for grabs. The ATO, though, is a different kettle of fish because the ATO can look through the corporate veil, and the directors can become personally liable in that situation. But again, with the family trust, unless there's some way they can say that one of those people control that trust, completely, then normally it's still protected from an asset protection point of view. In relation to family law, that's not my area of specialty, so I might let Michael help me out there. But in terms of a normal creditor dispute, it's the company assets that are up for grabs, not the assets of the family trust. The family trust is just simply a shareholder.
Let's check in on one of our viewer emails that we received during the evening. It comes from Kevin in New South Wales. I will be receiving approximately $105,000 from my mother's will. Will I have to pay tax on it? Michelle.
Well, essentially it's going to depend upon whether this is just cash being distributed or whether this is a value being distributed and whether it's coming out of super or not.
Okay.
So if it's coming out of superannuation, the money that's coming to him, then it's going to depend on his own situation. So is he dependent or not under the tax legislation? As we were saying before, if he's not a dependent, then there will be some tax to pay. If, however, this is just a cash distribution, there's a term deposit sitting there in a bank account, and it's just a distribution through the state. It's a corpus distribution, and there is no inheritance tax, so it would just pass through without any tax consequences.
Okay. Let's move